Okay, guys, I'm going to run through. I was having a chat with Eric Russell the other day about doing a very cool interview to show how traders go from losing to winning traders and break through, and what it takes and the dedication needed, etc., etc. And we got on to talking about indicators, and he benefits a lot from using various indicators. I use the indicators as well. They really helped me. So I thought Stocks to Trade's got, literally thousands of indicators. You can even customize your own ones, color code them, do whatever you want. I think I've said this before, extremely complex software, and it's made extremely simple to use, which is awesome. And it's very, very, very clean. I've not seen software like it. But anyway, let's run through because I don't want to take up too much time. But yes, there is a great interview coming up with Eric Russell, and I need to hook up with Tim Bowen because Tim Bowen's the lead trainer and guru on Stocks to Trade. This is my point of view of how I benefit from using the indicators, but I'm sure that he can give so much more insight. So Tim Bowen, if you're watching, we need to collaborate and work together. Tim, please, let's collaborate and work together. That's an open request to you. Okay, but let's look at KBSF first of all, and I'll just move out a little bit. So first of all, RSI, let's quickly look at it. RSI is just the relative strength index, and it looks at price movement and it scores it on a scale of 100 to 0. And basically RSI can tell you if a stock is overbought or oversold. So if it's above 70, it's generally considered by the industry as overbought. If it's below 30, it's generally considered by the industry as oversold. So when KBSF opens and it's touching the 90s, we can see that this stock is so overbought it has to come down, and it's coming down. But on the flip, when the stock is down in the 20s, the RSI is so low that it's indicating a trend change. And we really need to look for these trend changes as momentum traders. And you can think it's at its 200-day moving average. It is way oversold in the 20s. So maybe it's a good opportunity to buy, and obviously it runs up because it's been completely oversold. And that's just an example of how I like to use RSI. If it's really, and it's just an extra indicator to have on your side. If it's really oversold, just consider the dip buy if other things are aligning. If it's way overbought pre-market, think I don't really want to buy this because maybe it'll wash out in the moment or at the open. So that's RSI for you. The 200-day moving average is a bit simpler. It's basically the average closing price of the stock over the last 200 days, and it's as simple as that. But it's not a coincidence when we look at, say, KBSF, that it's not dipping randomly. It's like dipping to the moving average here, and then it's dipping to the moving average here. And if we look at another chart of KBSF, look where these moving averages are lines of support and resistance, and the green is 50, the pink's 200. You can see that where does it dip to, or where does it launch from? It's from its 200-day moving average. So it's just that extra indicator to think, this stock, its long-term chart is good. It's like a penny stocking framework DVD pattern. It's had its first trend reversal, green day here. It should likely run a second day, but it's a bit illiquid. Where shall I get in on the stock? Well, if it dips to the 200-day moving average, that's a good support line to buy it off. And you could be in from the 660, selling in the 8s for a major profit. So this is, and also, for example, you want to use the moving average as resistance as well. So if the 200-day moving average was here and the stock closed here, you'd think I'm probably not going to buy this because it's likely to have some resistance at its 200-day moving average. And the exponential moving average, the EMA, is probably my favorite thing to watch of them all. And I picked this up from Eric actually, and it's pretty simple. The EMA, it kind of takes into similar components as VWAP, but it's a little bit more up to date, and it takes into account more recent price action. So it's much more in sync with what's happening with the market at that moment. And we can see with the EMAs, it's pushing, and then it starts to kind of ride the EMAs, as I like to say, and it's as soon as it cracks the EMA, so when it's above, the buyers are in control. When it's below, the sellers are in control. And when it cracks here, it's a sign to get out. But for example, here, you can see that the RSI is really low, down in the 20s. and it starts pushing off the EMAs, and this is the time when you can follow the trend, and you don't have to get out until it breaks the EMA. So it's running up, consolidating, running up, consolidating, running up, breaks the EMA. Now it's time to start considering getting out, and then you get this push, and this last push, it's starting to get tired. When it breaks the EMA, it's like maybe the stock's getting a bit tired now, and then you can see it has this failed U shape, and it's done. And now the sellers are in control, and it's dropping, dipping below the EMA all the way. And again, another way to look at the EMAs is it's pushing so far off the EMAs. The RSI is up in the 90s. You want to be selling in the 11s here if you're in this for this breakout, because it's going to come back to the EMAs. It always does. So you want to be selling in the 11s, knowing that it will flag back to the 10s, because it will come back to the EMAs. So that's another example to think this has gone a bit too crazy. It's a bit too strong. I'm going to sell into this real strength. And that's how I look at the EMAs. And the last thing is VWAP. Golden rules that I learned from Tim Grattani is with VWAP, buy, never ever dip buy a stock below VWAP, and never dip buy a stock that's red on the day. These are the two rules that he kind of followed, and it's the two rules that I follow as well. And I'm the same with the EMAs to a degree as well. Like, I don't dip buy stocks that are below the EMAs. And like, for example, BIOC, is it no BCLI? Like, look, it's cracked way below the EMAs, so it's like you're on the wrong side of the trend. You need to wait, and it never recovers, and then it cracks below again here. So this is how I use the EMAs. But I'll leave that as a wrap. There's also Bollinger Bands, which they're just too messy on the screen, so I just don't use them. But with Bollinger Bands, very quickly, I'll just add them in here. We can sometimes Bollinger Bands are nice because you can kind of predict, like when they squeeze up a little bit, can't really see, but when they squeeze up a little bit here, sometimes it's a sign that it's gonna push, and then it's a sign that big volatility is gonna come, and then they really expand when the big volatility comes. And also, like, if you're hitting the top end of the Bollinger Band, it looks like it's overextended, so maybe you want to be selling. I mean, that's how I see them, but I really don't use Bollinger Bands, so I'm not the right person to talk about them. But that's a recap. Give it a thumbs up, subscribe to the channel if you liked it. Let me know if there's anything else you want me to cover, and I'll try and do it. Tim Bone, let's work together. And look out for the Eric Russell video. I'll see you later.